So the public is expecting 6% inflation. Meanwhile, Powell is still claiming that expectations are well anchored at 2%. Whose expectations is he referring to when the surveys are showing that consumer expectations is 3 times as high, 6%? Also, the number of people who are expecting a recession to begin this year rose to now a 9-month high. So people are more concerned about the economy. They're more worried about inflation. Also, Trump is continuing to beat the tariff drum, talking about how, the tariffs with Mexico and Canada, they're still on, right? They're coming in April. Maybe we're going to have tax tariffs on Europe. So all of this weighing on confidence, weighing on the economy, raising the prospect of recession, which again, I think we've been in a recession the entire time. Oil prices also moving lower. Again, I don't expect this to stay. I think oil is going to reverse, but oil down below $70 a barrel, $69 a barrel. The reason we're seeing this downward pressure on oil, and it's coming even as the US dollar is drifting lower. It's not collapsing, but the dollar index fell again today. We're down near the lows of the year. We're barely holding on to a 106 handle on the dollar index, 106.23. But the drop in oil prices is due to the fears of a economic slowdown, and that is what is prompting the rally in bonds. But what bond investors are overlooking as they're buying bonds is the strength in inflation, because inflation erodes away the value of the bonds they're buying. And so they're just focusing on the weakness in the economy, and that's kind of a reflexive move, probably a pre-programmed algorithm to, buy bonds because look at all this weak economic data. But the weak economic data is actually inflationary in that it's going to mean bigger budget deficits and a weaker dollar, which is going to push consumer prices higher. Again, this is stagflation, right? This is not the type of economic weakness that any of the people who are trading today or who are programming algorithms to trade have experienced. You have to go back to the 1970s to see economic conditions that are comparable, although they're worse now because the financial position of the United States has deteriorated dramatically since that decade. But you have to go back then, and recession doesn't guarantee lower yields. In fact, I think it assures higher yields. And that's why I'm confident that the rally in bonds is going to reverse. And that's going to be even more problematic for the stock market. But the stock market is already having a problem with this dynamic because the air is coming out of the bubble of a lot of the momentum names, right? These speculative stocks that have been bid way up based on the cheap money bubble and the good times rolling. A lot of these stocks are getting hit.